just very powerful, I believe, like, because it's obviously something that people do. I think my whole value out here is just calibrating it to 2007 drops and showing that, okay, that actually worked. And that other things are not predictors that people think that they are.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
There's just a few questions. I know you've covered a million things here, so thanks for doing that. This has been fun. It's really, I've just kind of held on and felt like I was drinking from a fire hose as you talked about all these different things, that you can use data to do. One of the downside predictors that you had mentioned was the affordability deviation, which I think you gave us a great explanation on that. Was there anything else that you used for a downside predictor besides the affordability deviation?
Well, what I've been doing, so I have like an analytics LLC called NV Analytics. So we publish downside metrics there. What I've been doing there, I've been actually trying to do like a more advanced measure that also incorporates population and housing supply. It does not perform that much better than if you, that's what I was saying, that very simple. It's a little bit better maybe. But the goal of that one is really to capture the small geographies like counties. If you take like something like, Washington, DC or San Francisco, like there's this dynamic that I mentioned that, okay, affordability changes over time and like quite dramatically. And so I wanted to capture in a more precise sense, since this change presumably is due to housing shortage, because that's what is at least believed. I believe in other studies on this topic, that's due to housing shortage that it shifts in this way. So I wanted, okay, let's capture the initial fundamental components. So what I use is, so it has income. It's kind of like a bigger regression that has like income there. It has population growth. It has housing supply, and sort of trying to predict where prices should be now and versus where they actually are, and the deviation in that. But I just wanted to stress to people, since it's something that anybody can do in a very easy way. So they could go to nvanalytics.com, is my website, and they could purchase the data, or they could reach to me for more information as well. But it's really something that anybody can do as far as, just price income. And it's just very powerful, I believe, like, because it's obviously something that people do. I think my whole value out here is just calibrating it to 2007 drops and showing that, okay, that actually worked. And that other things are not predictors that people think that they are. Or like, if we take the state of New Jersey at this moment, let's say, like, if I hadn't done this study, I would read articles that say, okay, foreclosure rates are really, really high in Sussex County, New Jersey. Sussex County, New Jersey is maybe number one by foreclosures nationwide. And it's a pretty decent area, it seems, but somehow foreclosure rates are not that high anywhere now, obviously, since we're at a good point in the market. But among those not so high foreclosure rates, the highest ones are in the states of New Jersey, and there's in Florida is kind of a bit of a foreclosure state, and others, in Illinois and Delaware, etc. And so let's say one would think, so this is like it's such a ripe, like foreclosure state, the state of New Jersey. Maybe it's risky, and those are your downside predictors. And no, that's when I did like this kind of study, that's not the case. You can have like high foreclosure rates, but counties in New Jersey are actually undervalued, and the state is undervalued at the current time. It was overvalued in 2007, and that's why it dropped, because at the time it was like 25% undervalued, and it dropped maybe 28% or something like that. It was pretty close to how much it was overvalued. But at the moment, New Jersey is, I don't remember the correct now, it's maybe 7% undervalued. So this is an example, and it's a big foreclosure. It's like there's foreclosure rates are relatively high, but it's not the driver. And so that's, I think, the value to anybody can really do it. Like, it's free governmental data. They can go to FHFA. It's one of the price sources on the government side, so Federal Housing Finance Agency. for incomes. They can use Bureau of Economic Analysis, then population and housing supply. So that's available in census data. So yeah, it's very powerful. It's been available. I mean, that's what economists use in a way, like when they judge like the market. It's just, I personally never heard the extent to which, because if you take at the counties level, because I believe I mentioned the correlation at the state level, at the counties level, the predictability of the actual drops that happened in the future, and that's in the future, right? That's at the counties level is 74%. So that's a regression among close to 3,000 counties or 2,800 counties. And you have a different peak date in each of those counties. Let's say one of them peaks in the third quarter of 2007, one maybe peaked in 2005, one maybe, at a different time, maybe two even later and didn't drop. And then that was the case in some cases. That sometimes happened. And so those different peak dates, then the drop continued and took on average 4 years for the drop to happen. And in certain counties, it took maybe 2 years, even very short. In some certain counties was 6 years. And so, but this from peak to bottom downturn was predicted 74% Pearson correlation. Now that's when one looks at the data of something that has 74% versus correlation versus something that has 87% correlation, it looks very different. It doesn't look that strong. You see, okay, it has like different percentages, different numbers, But again, this is a regression of 2,800 counties. It's small geographies. They're hard to predict, and even there, one could have a decent measure of knowledge of your downside risk. And then if on the upside, if let's say if one let's say is being skeptical about correlations and things like that, but then if you take, how do you pick markets anyway? So you're gonna choose like population growth and job growth and etc. And what are the correlations of those two? Like you said, like population growth has like 40% correlation, even at the state level. And states are easy to predict, so it's not that high. But when you combine it with other metrics, then it gets actually powerful, and it's worked well. And people who are like investment managers in the field, they know it, and it's not all that hard to work out which the good markets are or have been. So that's it's just simple. And I thought it's been so simple and nobody's using it, so I thought, why not? So that's I can share like this piece of information. It's been like amongst like the other things, like the other data-driven things on the property side, it's been like 98% of my work, and then the market analytics maybe 2% of my work, and then it's the maybe 90% of the publicity is on the market analytics side.
Man, this is fascinating. Yeah, fascinating. I love your line of thinking and just how you get in and really go deep on this. I mean, for a lot of us, you mention all these things, but for the doers amongst us, that sounds like a lot of work, right? And it's also, if you're not a data scientist or you're not somebody that really just loves taking all of this and compiling it, how does someone learn how to do this? Do I learn it from you? Do you do it through NV Analytics? What's that look like?
Well, I've been doing some mentorship on that. It's kind of taking me, I would say, it's not the most productive use, but I'm happy of my time, but I'm happy to do it sometimes for people. So I have it on my website. They can go to nvanalytics.com, ENVVY, so the vanalytics.com, and they can go to mentorship. And so I do like a 5-session course where I show to people, literally guide them through my scripts, so my like Python scripts, and I show them what I do, like what I do on the market side, what I do on the property side for residential real estate, what I do on the property side for commercial real estate, and things like that, and what I do off market versus on market. And so that's I'm happy to help others. So
Man, that's fantastic. Yeah, for guys like me, I'm gonna want to come to you and say, "Hey, man, either do it for me. How do I pay you to do it for me?" Or, show me how to do it. Because this, building a lot of this stuff on the back end, I'm sure takes quite a bit of work and an understanding. Like I think you just used the word Python script, and that on this side of the microphone means absolutely nothing. So
it does, and actually, I do admit it can actually take indeed too much time sometimes, and to a point where it's not good for your business. So it's again, like, it's not like to take you on data driven, being religious and you have to do it this way, because in a way I have seen this in my own practice. Like I said, when I was dealing with residential, I was looking for.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.